So I tweeted the other day that I feel like there's another risk off wave coming because I could feel it in my balls. There's really no science behind it. I just have a feeling that we saw that risk off wave when TLT ripped and they priced in more cuts. And I kind of feel like we've got something else brewing under the surface. What do you think about that?
Certainly think that's a possibility given the regime that we're in. And then, I mean, you could even see something like today, NVIDIA earnings come out, right? They are down 7% with a double beat in raising guidance. So obviously, it has a lot less to do with like the idea that these companies aren't growing. I think the issue is um, the expectations of where they're supposed to go were or maybe still are quite lofty. And I think that coming down to reality, might be just the signs of a slowdown, right? Like we've been saying this for, I don't know, months now, at least a couple months now, where slowdowns don't equal recessions, right? Just because you see a slowdown doesn't mean you're guaranteed a recession. And slowdowns can yield environments where stocks and bonds rise, but ultimately bonds should outperform stock, right? So I think in this environment that we're in this slowdown, I should say, TLT should have continued momentum here. I mean, like you just said, right? We ripped here with the NFP numbers in August, at the beginning of August, so at the beginning of this month. We legged higher with NFP. We pulled back, and we've been pretty much consolidating ever since. And next week, we have the next NFP release, right, for August due in September. And that will deter. And I think maybe bonds kind of crawl out either way, up or down from that.
Yeah, and I think like since our system has been showing slowing growth for quite a while now, I think now we're starting to get into the point where if it really is a growth slowdown, we're going to start to see it being reflected in company earnings because those always come a little bit later. It's kind of like a lagging effect. And I could see that scare the market a little bit and give us another leg up in bonds once companies start missing or just like you said not making the mark of these high expectations that we've been having.
Yeah, and I think that's really not going to be something that we can kind of put our finger on until it happens, right? It's one of those things that's like it has to happen first for it to be like for us to move to the next step out of a slowdown. You're gonna have to get the wave of companies missing estimates, right? Like it's gonna have to that breach is gonna have to happen somewhere. So like there's quite a bit of ways I think before we even see a recession. Not to say that they can't happen and they don't happen quickly when they do, but I think right now it's safe to say we're in slowdown land. Maybe we're in the middle of it, maybe we're in the deeper side of it, but like we're in slowdown land. We're not in a recession, and unless you kind of get that risk off acceleration on a fundamental level from these earnings reports and just unemployment, right? Really accelerating, which we'll see that picture next week. Um, that's where you kind of move from the recession, from the slowdown into recession land. Now, as I just said a few minutes ago, just because you have a slowdown doesn't mean you have a recession, but it also means that because there's a slowdown, if it's not addressed properly, it could lead to a recession. So this is why our models are set up the way that they are. They look for asymmetrical opportunities, and that essentially means they look for opportunities that yield more in one direction than they do in the other. So in this example, our models since the beginning of July have seen or expected more positive returns from owning bonds than owning equities. And I mean, if we take a quick look at what's happened since then, right? So let's take a look at what happened since our system pivoted, and what you'll see is pretty clearly bonds have outperformed both equities, Bitcoin, commodities, and even gold, right? And I think that this is just a sign of the times right now, the regime that we're in, and eventually equities will outpace bonds as they always do at some point. But until that happens, I think we have to take the current environment at face value. We're in a slowdown. And until the regime model shifts, we have to respect what we're seeing.
That's interesting to see gold also be an outperformer up there with bonds because gold is kind of like a turmoil predictor. It's not really an inflation hedge. It's more so of when shit's starting to hit the fan, people flock to gold. So I wonder if it's trying to tell us something here by being an outperformer along with bonds here.
It could, but I mean, also like I think everyone and their mother at this point. I mean, we had Powell literally 5 days ago, right? Say time has come for interest rate cuts at Jackson Hole. So I think that the market's pretty much baked in for a rate cutting cycle at this point, and gold loves rate cuts, right? Gold loves that disinflation slash deflationary environment. And I think that that's why you're probably seeing a bid in gold. Um, I do think you're right though. Gold and bonds, I think we can even put them together. We don't even have to isolate gold in that scenario. Bonds and gold love turmoil, right? Rate cuts alone aren't going to be what propel the bond trade significantly higher from here. So, for example, if we look at what is currently being priced into the Fed funds futures for the end of the year, four interest rate cuts right now, pretty much four rate cuts. Okay, and by June of 25, so think mid next year, there's about almost 8 rate cuts. Okay, so we're going from 4 days. So we're looking at about 8 rate cuts in the next set over the next 7 meetings. So I think the key here is to understand the pace and the trajectory of the Fed, because there's a lot of people that anchor the bond trade on if we're going to get 3 or we're going to get 4 rate cuts this year. Meaning, if we're going to get 4 rate cuts, there's only 3 meetings left. That means that one of the meetings, the Fed is going to have to cut at least 50 basis points, right, to get those four total cuts in 2024. Maybe they only cut 3 times, one at each meeting. That means you only get 3 cuts, right? Oh, so because there's one less cut now than 4, right? So instead of getting the 4 cuts, we're getting 3. Bonds should perform poorly, and that's the consensus behind bonds in the current state of things. And I think that's a little bit too sensitive, right? I don't think we can focus too much on what happens here in the next over the next 3 meetings. Bonds really care about the cycle. They care about the entire plotted or implied Fed cycle. They don't just care about 1 or 2 meetings. Like if you're watching this and you take a look at the screen here, you'll see that December 24 is only 3 dots on this long line. Bonds care about the speed, or think of it like the incline or decline, and the terminal at which the floor or the ceiling is in the policy path. So right now, the policy path has rates bottoming out at 3%, pretty much on the dot, in 2026. And this has been so for a couple of weeks now, pretty much ever since, if we go back to TLT, this has been this way since since we had that last NFP release, and bonds have gone nowhere. Bonds have gone nowhere because the floor hasn't dropped lower. So I think for us to get that leg higher, that next risk off leg, we're going to need to see this floor drop. Now, some people are saying, well, we're talking about 200 basis points of cuts here. This is the bond market saying a recession. And we've gone over this in multiple podcasts at this point, and I want to just keep it very simple. The Fed bottoming at 3% in a recession would imply that the entire economy is no longer the same as it was, or is no longer the pre-pandemic economy, meaning, inflation is not going to bottom out under 3%. Okay. Inflation is going to just basically sticky and grind up, and the neutral rate is significantly higher. That's the only point at which the Fed would end up bottoming at 3% in a recession. In my
Well,
opinion, I don't think.
does the
Go ahead.
floor need to be below the rate of inflation
For what? For a
for
recession?
it to be for us to be at the neutral rate? So like pre-pandemic level, would we need to have that floor be lower than inflation?
I don't think that it doesn't need to be exactly lower, but I think you need to like the way you have to look at it is say this: say inflation's averaging 2%, right? Um, if the Fed is above the inflation rate, the odds of them becoming restrictive start rising, right? And the odds of them becoming easy rise if they're below the inflation rate. Now, it's not tit for tat. Like, we're not going to say, like, oh, yeah, like, let's, we need to be exact. We're not zeroing out this to a decimal point. But to some degree, like, if the Fed is above the inflation rate this entire time, all the way out to 2026, odds are they're going to be restrictive the whole way through. That's not a recession. That's not what the Fed is doing in a recession, especially not an inflationary recession, right? If you're in an inflationary recession, which is stagflation, we saw that in 22, right? 2022, then this type of curve could be a resemblance of an inflationary recession, but I don't think we're going to see that, or we're seeing that at all right now. So I think just like the equity markets, the bond markets are priced for a slowdown, not a recession. And I want to kind of shed some light to this too, right? Because like a lot of people are like, oh, the bond market's pricing in a recession, but the stock market's pricing in an economic expansion. The bond market and the stock market are not two different foreign markets. This is all interconnected. If the bond market's pricing in a recession, the stock market's feeling it too. So it's very clear that the bond market isn't pricing in a recession, nor is the stock market. But it's also very clear that the stock market and the bond market are pricing in some sort of slowdown. I mean, we're having these wider ranges, volatility's picking up, uncertainty is rising, right? These are all signs that there might be some deterioration in economic data, but it doesn't necessarily mean we're in a recession. That's the key here. And I mean, even take a look at Bitcoin, right? We have a range bound channel here in Bitcoin where we're not really going above. We're making a bunch of lower highs and a bunch of lower lows, but we're not really breaking down significantly or breaking out significantly. Again, this is not symbolizing real risk on behavior. Real risk on behavior in Bitcoin is up only, literally. It's so easy to tell when you're in risk on with Bitcoin. So I think the key here, right? And I'm sure you see this too, is to not jump so quickly into the bear camp in terms of like impending doom, and kind of just let the regime guide you through, right? So right now we're in the slowdown phase. The recession phase will become more and more evident, and the case to claim a recession will become more and more evident as we progress through the cycle. Jumping the gun right now with unemployment, in the low 4% range as of the last print, I think it's a little premature, don't you think?
Yeah, definitely. And for that floor to really go lower, we need to see unemployment rise.
Oh, for sure. Yeah. But let's go to the next topic here. Let's talk about what we're seeing here tomorrow, right? So this podcast is getting dropped on Wednesday, and tomorrow we're gonna have the update to GDP numbers to the second quarter, right? Just an additional data point there. I believe it's the let's see, quarter. Yeah, it's quarter two preliminary. So it's not. We had the advanced last month. Now we're going to get the preliminary, and then next month we're going to get the final for quarter two. So the key question here is going to see if we get a similar print to the prior, or we get another like some downward revision. That would be, the consensus range is 2.6 to 2.9. The prior was 2.8. So if we, get a downward revision here, that's not going to be good for the whole GDP picture. It's going to essentially symbolize that there may be more weakness coming in growth. But right now, we have to take it at face value. Maybe it comes in hotter, maybe it comes in colder, but that's something to watch out for tomorrow. And obviously, we have jobless claims, right? And then on Friday, we have PCE. So it's not really a jam-packed rest of the week here. I don't think it's going to be anything too exciting, to be honest with you. I wouldn't be surprised if you would just like mute these alerts altogether and nothing really dramatic happens in the markets. I think the real key at this point is going to be NFP next week, and the next FOMC meeting.
Yeah, and it really seems like bonds are waiting for that. They've just been chopping around, waiting for more data to come in.
I mean, it's so clear, right? Like bonds made this. So if we measure the move of where we were so we bought bonds on the 2nd, right? July 2nd is when we bought them. And TLT is up 8.53% since then, right? But what you'll notice is like most of this move really happened in, I'd say, like the first like half of the time. The other half of the time we've been just consolidating. Right? So it's like we've been consolidating now for quite some time here. And it's almost as if like bonds are just waiting for the okay to go higher. Meaning like if we look at rates, like they're whoops, sorry. If we look at rates, it's almost like they're looking for the okay to go lower. And if we just take a look at where they are right now, I mean, we'll cut the noise off here just to see. And I posted a tweet earlier this week about this, and it's pretty interesting, right? So assume we're in a situation right now where inflation, right, is below the 2018 highs. Inflation swaps are below the 2018 highs. Labor market's weakening, right? Why should the long end be above 3.5%, which is rounded up, but it's pretty much close to the 2018 highs? Why? And I think that's like the real bond thesis here. If the cycle is if we're in fact deteriorating through a slowdown with a possible recession down the road, the idea is like, okay, where's the risk reward here in yields? Are they going to really rise significantly, or are we faced with a situation where like everything's kind of breaking down in terms of what's going to move bond yields, right? We have growth deterioration and inflation deterioration or disinflation. So no one can seem to make a solid base case of why the rates need to stay above even this red line, right? Forget the red line. If call it 4%, why are rates above 4%? And I think that this comes down to, there's some wild claims out there about the deficit. Oh, government spending, someone's gonna have to buy the debt. But again, we'll just go back to TLT. Right when the last NFP print came out, the idea that who's gonna buy the debt, literally there was like 7 straight days of buying. Like there's people ready to buy this debt. I think what people are really looking for is like the confirmation that we're in a slowdown. Our systems tend to be a little early, so like we've been seeing the slowdown for months now. I think people are just waiting for more solid confirmation of a slowdown and possibly even a recession to really get the bond trade moving.
Well, what are your thoughts on the whole government spending scenario? Government spending causing inflation and bringing back inflation.
I think that there's a factor of government spending that's going to be alleviated with interest rate cuts over time, right? So like as the Fed cuts interest rates, and if we take a look at the Fed funds rate, right? Now, no doubt the government's spending pretty aggressively, but the idea here is like a lot of people are now we're getting to the point where we phased in the interest. So the Fed has lifted from pretty much 0 in 22 to 5.25 now in 24, right? So 2 years or so, a little over, year and a half, whatever that may be. And now you're starting to see that show up in interest expenses of the government, right? So the government's financing costs are starting to appear because you've kind of rolled over a lot of that low interest debt steadily into this higher interest rate environment. And that's going to add spending pressure by the government to basically finance debt because it's going to cost more to finance debt. But if you're going to go on a rate cutting cycle here with the projection to bottom out at 3% in 2026, what's going to happen is you're going to start alleviating some of those interest expenses. This topic of the government spending so much on interest is going to start coming out of the picture. We just saw a 2-year mega ramp of it coming from 0 to everyone's talking about, government spending more on interest than it is on defense, whatever it may be, right? The key here is like we've hit the apex. So now we're going to go into this phase where like that's going to phase out. People are going to start talking less and less about this idea of government interest expense. I think the government's still going to be spending money, but I think you're going to have some alleviation there as the Fed brings rates down, as they should, right? And I think that there's also this understanding that the government is in a position like with our country, the GDP and the outlays to GDP, it's in a position where it's not super severe, right? If you take a look at what we're spending on interest payments, and versus what we're really here, I may have a chart on X. So I just want to show this chart here, right? When we speak about like the interest outlays and what's going on, if you can take a look here, the interest versus debt outstanding right now is at 3%. So in terms of total debt outstanding, the interest costs are at 3. This will rise, as rates stay higher. But the idea here that we're at extremes is quite um, blown out of proportion. And then you just look at interest percentage, the government spending versus GDP. Again, quite blown out of proportion. It's like we're talking single digits here, right? Now let's talk a little bit about actually what the government's spending in interest versus what they're having in receipts. So the government's spending about, this is going to be over 20% now, right? But 20%, over 20%, or I'd say anywhere from 20 to 25% of what they're receiving on interest. This is coming up from about 15% that it averaged for nearly 20 years. Right? So this idea that like rates are extremely high, like we look at where rates are going to come down. So that means that this percentage is going to fall in the next couple of years.
Wait, in layman's
Right?
terms, can you explain interest versus receipts?
Okay, so interest versus receipts is essentially saying how much is the government collecting and what percentage of that are they spending on interest for their debt? So think of it like the government collects $100 in taxes, $21.91 is going out to interest on debt, on bonds and notes and bills.
Yeah, okay.
Right?
Yeah,
Right?
we can
So
basically
this
see that rising tit for tat with the Fed funds rate, pretty much.
correct. And this idea that like the government's on an unsustainable path, like, yeah, I think ultimately the debt path is pretty aggressive, but this idea that like we're near like a breaking point is we're quite far from that, right? Like I would be concerned if this number gets closer to 50%. That's where it's like, okay, we have a problem.
Yeah, well, I mean, even if it gets like above 30%, that's
I'm
higher
sure
than
then, yeah,
where it's
yeah.
been in the last 60 years.
Yeah, and like again, we have literally the Fed green lighting a rate cutting cycle that's going to commence in the next 30 days, right? Or next 2 or 3 weeks. So the idea here is like this is only going to have pressure be alleviated. Like this had all these tailwinds boosting it higher, but I think now we're going to have like a kind of reversal, and slow and steady people are going to start talking less and less about interest expenses and more about the next crisis, whichever one that may be that they develop on, on in the timeline. So
Yeah,
I think
there's
yeah,
always a bear case.
there's always a bear case. Yeah. So I think to summarize, excuse me, the current situation, we look at the Nasdaq, and we just see like we see this range action going on here, massive unwind with I think this was really where the market picked up on the slowdown. People will call this the carry unwind. Nonsense. The growth was slowing before, our growth model was slowing well before this happened. And the reason we haven't hit new all-time highs on the Nasdaq is I think the growth situation is pretty much still depressed in terms of its trajectory. So I think that's why equities are doing what they're doing. Could we go to risk on? Could we turn this around? Very well, very possible. And in that case, we'll be back to gung-ho equities. But until that happens, we're going to lay in the bonds and wait for more cleaner and crispier times there. Commodities, I think, I speak about this on the timeline quite frequently. This is just a somewhat some type of demand proxy in a way, demand slash inflation, right? Growth slash inflation. It's not really clean because it has two components, but the idea here is, look, commodities are well off their 23 highs. We're well off the 24 highs at this point. Under mid-vamp, we're in a bearish trend. We could see new lows here. I think ultimately commodities breaking through the August lows, which is about 20, you could say 20 and a half, 20 and a quarter, 20 spot 30. If commodities break below there, I think selling pressure in equities really accelerates because that's a signal that demand is really deteriorating. Until then, though, bearish trend, we expect the prices to go down, so commodities aren't along, but it's just pretty much chop to downwards price action here. And
Yeah,
then
I mean,
finally,
same goes with crude oil for that one too, right?
100%. So let's take, I mean, we'll even look at that, right? Like crude oil, bearish trend, below the 24 highs, below the 23 highs. We're below 24 highs. We're below 21 highs. I believe we're below the 23 highs. So at this point, it's very simple. Yeah, we're way below 23 highs. So crude above 76, 77, I think we could start looking for a possible trend shift, maybe a possible bump in the disinflation as we saw here in June. But I just don't see that happening right now, given where our growth is and where just commodities are as a whole. I think it's pretty weighted to the downside for crude. So obviously we don't short commodities. We don't even trade commodities at Market Radar. So, to us, they're just a price gauge. But I think commodities as a whole have downside risk. Crude has downside risk. Bitcoin has downside risk. Bonds are pretty much the only thing right now we see with upside risk. And maybe some short volatility, but that's about it. So I think we could wrap up the podcast here, though. It was a good conversation. Thank you so much for listening, guys. If you have any questions, feel free to reach out to us at the Market Radar on X or go to our website at market-radar.com.